got a really great lineup today to talk about all things secondaries and pre-IPO investing. So get your questions answered if you have them. And then other housekeeping note, we are going to have some poll questions integrated throughout a bit of the conversation. The goal is to get a better sense of where you all are at in your investing journey and be able to kind of cater the conversation to that. So we appreciate your engagement with the poll so that we can make sure we're giving you as much value as possible. But I think that's all I have from a housekeeping perspective. So looks like we have started to cap out on people joining. Hope people continue to join throughout the conversation. But for now, we're going to go ahead and get started with some intros. So I'll kick it off. My name's Hallie. I am the head of marketing at Sydecar. Sydecar is an SPV formation and administration platform building the infrastructure to power private markets. And we're here hosting this conversation today about all things secondaries and pre-IPO investing. Like I mentioned, we have an awesome panel, really good perspectives across GP, LP, platform. And so I'm going to let our panelists introduce themselves and then we'll be off to the races. Someone jump in and start off.
Sure, happy to. Andrew Seda, I co-run capital markets at Forge Global, which is one of the largest secondary marketplaces in the United States. Technically, I also work for Charles Schwab. Our company was acquired a little over 2 months ago. Um, Before I worked at Forge, I was at a company called SharesPost, which was one of the early pioneers in the secondary market. Starting in 2016, was there for 5 years before I went to Forge, and have really focused on kind of bespoke, large institutional secondary transactions for the last decade.
I'll go next. Matt Curtolo. I have two hats that I wear primarily. One as an advisor to emerging managers and working with a lot of smaller GPs, thinking about fundraising strategy, thinking about how to go to market, think about just the broader landscape. What really informs that is 20 years as an LP at places like Hamilton Lane, MetLife, Hurdle Callahan, and Allocate most recently. So I've worn the LP hat in a variety of seats across a number of markets. My secondaries experience goes back to 2008 when I was on the founding team of Hamilton Lane Secondary Fund. So it goes back quite a ways. The other hat I wear today is also as an active LP for a multifamily office in Australia.
Awesome. So you liked secondaries before they were cool, is what you're saying?
Yes.
And hi, everyone. I'm Eve Denton, currently co-founder and general partner at Dark Pool Capital, where we are focused on investing in later stage companies, 1 to 4 years from IPO, entirely through secondaries. So at DPC, we've deployed a little over $140 million to date into secondary opportunities. And prior to that, I spent 5 years at G Squared, which is a much larger secondary focused fund. So it's not in the secondaries quite as long as Matt, but I've been in the space for quite some time.
Awesome. Thank you all. Yeah, so I think to kick us off, we'll do some poll questions. Like I mentioned, these questions that will pop up on your screen right now are really to give us a better sense of where you all are at in your investing journey and with regards to secondary specifically, so that we can kind of cater the conversation accordingly. So please engage with that first question that's up on your screen. We'll give you a couple more seconds to answer that one, and then we'll do one more after this. Um, and sometimes I sing elevator music at this point, but instead I'll just give you a 5, 4, 3, 2, 1 countdown. And then we'll pop up the next poll question on the screen shortly. Again, thanks for engaging. I don't see it yet, but maybe you guys do. Okay, there we go. Sorry. So you can, yeah, we'll do the results of the first question and then quickly after that, we'll do the second question, trying to get a better sense of where all of you are at in your investing journey, like I mentioned. So this next one is about if you've ever executed a pre-IPO or secondary deal yourself. And we'll give you just a little bit longer on that one before we pop up the results in, let's call it 5, 4, 3, 2, 1. Cool. So We'll see those results. Yeah, it looks like a pretty standard variation across the board of people who have dabbled on both sides of secondaries as buyers or sellers. And of course, lots of folks who haven't, which I think is like a smaller and smaller group over time. But we will definitely help you feel equipped regardless of where you are at. To start off with, I'd love to throw out a question to any and all of the panelists. Just really like a temperature check on the market. Would love to hear from each of you. How would you describe the secondary and specifically pre-IPO market right now, and how does that compare to things maybe 12 months ago? Obviously, we're hearing a lot about secondaries in the news, the media, online, and so would be helpful to hear from each of you based on your personal experience. Andrew, you want to kick us off?
Sure. From a broker perspective, there's a ton of capital aimed at the same 5 to 10 names. It's very frothy, whether or not we're in an AI bubble or not, I think is a question that people are talking about on a daily basis. But compared to, beginning of 2025, I would say that the demand is several factors higher than what we saw Q1 of 2025.
Yeah, appreciate that. Matt, Eve, jump in.
Yeah, I think the from wearing the LP hat, I think the idea that there is almost insatiable demand for some of these companies, right? I think if you think about 4 or 5 names that we all could probably rattle off, these things will fly off the shelves at almost any price. I think for the rest of the market, from an LP's perspective, there's still some interest. I think even Andrew probably have a better sense of that next tier of companies. But I think as an allocator, you think about what you're getting with that exposure. Right now, maybe we'll talk about it in a bit, but thinking about the path to liquidity for in a lot of these positions is, I think, where the LPs has. Pre-IPO, I think historically it maybe meant 3 to 6 months or a year before that's happening. Now I think it becomes a much more amorphous or hard to judge perspective. So late stage pre-IPO, all of these things in a portfolio, you think maybe lower multiple but faster returns. We're kind of in that mix now. So I think LPs are in a little bit of a wait and see process. Still a fair amount of demand for the largest names. And I'd say a mixed bag when it goes beyond that.
Yeah, I think we're seeing a lot of actually really interesting opportunities outside of the top 3 or 4 names. And thinking about where we are now versus 12 months ago, there's huge concentration right now in a handful of assets. I was joking that if I had $1 for every time someone asked me for Anthropic stock, my valuation would be around where Anthropic is right now. But there's just sort of this like laser focus on 3 or 4 assets, and also so much FOMO around them that I worry a lot of people are also jumping into deals where you're told you have 36 hours or 24 hours to make a decision and sign a subdoc, and so people are then getting into situations where they might not know the counterparty super well. And then on the other side of the coin, there are all these incredible opportunities in companies like 5 to 50, really great assets, but not a lot of attention being paid there. And so I think actually a lot of interesting investing opportunities and some more value plays in incredible, large, profitable companies that will probably IPO in the next 12 months, but aren't SpaceX or Anthropic.
Totally, yeah. A counter narrative from Sidecar's data, and I'll try to get this data point right, but from the past 12 months, I think we've seen 15% of secondaries on our platform have been concentrated into those. I think we looked at like seven-ish names, the ones you would expect. Only 15%. So, I mean, that leaves a lot of percent going into other names, Steve's point. The news cycles and a lot of the hype is around those big names, but there's definitely other opportunity out there as well. And since I mentioned data, and we know people love to talk in terms of data and again, cut through some of the noise by hearing what's actually going on behind the scenes. Andrew, Forge obviously sits at the center of so many of these secondary transactions. So would love to hear from you. Like, what does the data show about things like volume, pricing, and then again, like which names are in the highest demand right now?
Yeah. So I think one of the things you can look at right off the bat is the Forge Private Market Index versus the S&P 500. In 2025, I believe the private market index was up almost 95% compared to 18% for the S&P 500. And then year to date, it's up another 16% compared to 5% for the S&P 500. So private markets are outpacing public markets. I think a lot of that is largely driven by how insane some of these AI valuations are increasing at such a quick pace. And I think another kind of thing is if you look at the buy versus sell indications on our platform, it's currently hovering at about 2 to 1 buy to sell. So there's a lot more demand than there is supply, and it's increasingly concentrated in the names like Anthropic and SpaceX. And that doesn't even tell the full picture because a lot of institutional investors, if you want to buy $500 million of Anthropic, you're probably not necessarily going to put that publicly anywhere. And so I think if you include the institutional demand, it's probably closer to like 9 to 1 buyer to sell side interest. And so, yeah, it's been pretty significant to say the least.
Yeah, absolutely. Appreciate that. And then Eve, as you mentioned, you've kind of been in the space for a while and you built Dark Pool Capital specifically around late stage secondaries. So can you walk us through how you think about sourcing deals and specifically whether a name is worth pursuing and then maybe touch as well on what would make you pass on a deal?
Yeah, so I think one of the most important things is kind of figuring out what your differentiation or unique access is going to be. I think that the platforms like Forge are incredible for kind of information sharing and bringing a lot of transparency to these markets that were previously quite opaque. But if your entire source of supply, sorry, Andrew, but if your entire source of supply is just what you're finding on Forge and that's it, it's pretty democratized at this point. And I think it's wonderful that Forge has done that, but it also means that for someone who is an emerging manager trying to build relationships with prospective LPs, I've really had to figure out what our edge is going to be. And so in the case of Dark Pool Capital, we named the firm Dark Pool Capital because we want to act as dark pools in the private markets, similar to dark pools in the public markets, where we're bringing kind of discretion to this space and allowing for fund of funds and funds with kind of fund life issues or large LPs to access liquidity through avenues that are kind of going to allow them to maintain that discretion. I think in terms of where we pass and how we think about sourcing the actual companies that we're in, companies will pass on sometimes they're just too early. Sometimes they don't meet our core investment principles. So when we started the firm, we set out with sort of 8 items on a report card and we measure every investment against those 8 items. So we have a clear list of companies, 20 or 30 companies that we love, but from there we'll pass on deals sometimes because of pricing. I think it's really important to not let a good company blind you to a bad price. Every single asset out there has a wrong price to it and also probably has a right price to it. And so kind of figuring out what your price is going to be and staying disciplined is really important. And then also thinking about exits in these opportunities that you're getting into. If you invest in a company that ends up not going public for 5 years or 10 years or way longer time horizon than you expected, are you going to be able to sell out of this opportunity privately? And if we're going to be pretty restricted in our ability to exit, that's another reason why we would consider passing on a deal.
I'm going to go off script a little bit. I'm curious how much of what you just mentioned are things that you or principles that you had when kind of starting out founding the firm, and how many of those things are like lessons or rooted in lessons that you've learned over the past several years?
Both. I'd say when we started the firm, we kind of looked back at our track records of investing and said, where did we go right and where did we go wrong? And we focused a lot more on the mistakes. And kind of figured out what sort of lessons and guardrails we could put in place to avoid making some of those mistakes in the future. And I think we're really comfortable passing on great opportunities that don't meet our investing profile. Because one thing that you have to think about, even doing SPVs, is as a manager, you're putting your stamp of approval on this deal. And so getting someone access to something that they love, but you don't think is great, if they end up losing money on that deal, they're going to still associate it with you, even if they were the ones asking you for it and they were the ones who were really excited to do it. At the end of the day, it's going into your investment vehicle and it has your name on it. So make sure that you're kind of comfortable with what those deals are.
Yeah, I like that a lot. I think there's a lot of good conversation about the value of SPVs and like allowing LPs to pick, but at the end of the day, you as the manager, the sponsor, are putting your stamp of approval on it, like you mentioned.
Hallie, do you mind if I jump in on that? Because I think
I would love
I have
that.
sort of 2 points on what you've just mentioned. On this whiteboard behind me, I have a quote, two quotes that I got from about 15 years ago, a CEO at a former firm that I worked at. He had these two phrases. He says, "No investment or no asset is a good investment at any price, and almost any asset is a good investment at some price." So I think that's the mentality I think about, not just with the secondary market, but in general, right? The price matters a lot, the quality of the asset matters a lot, but it's all about kind of putting those together. As I go on the counter side of the table, having conversation with a CIO last week, we said, if folks aren't going into these companies, if you don't have a position in Anthropic, whether that be through a fund or through a secondary now, having a zero weight is a position, right? You are making a case. Now, you could argue today is not the best entry point, but is having no exposure something that you want to do? So I kind of see both of these tensions with LPs and allocators kind of thinking about, yes, we want to be price disciplined. And Eve, I think for your strategy, that's absolutely the right idea. And then thinking about the allocators who, it's not really FOMO, but by not having any exposure to these assets, you could leave yourself open to things as you get benchmarked and sort of all the like.
Yep. Yeah, appreciate that. And as has come up in even just the past like 30 seconds of conversation, there are a whole lot of challenges that come into play that are unique to secondaries and pre-IPO investing. Pricing certainly one of them, and we'll circle back on that. But time for another poll question related to challenges. We'll pop up this next and final question just related to like, what is your biggest challenge when it comes to pre-IPO and secondary investing if you are participating? Again, we know pricing, sourcing, catering to your LPs. We've kind of covered it all and we'll continue to go into more detail, but would love to hear from you all as we keep this last poll question up for just a little bit longer. And I think we can go ahead and close it now, pop up those results. Yeah, lots of pricing. Good. Well, like I mentioned, we'll talk more about that in just a bit. But moving along, Matt, back to you. You've worked with hundreds of GPs throughout your career. When an emerging manager comes to you with a pre-IPO or late stage secondary deal, what is it that you're really looking for?
Yeah, I mean, in a lot of cases, the two kind of go, with the exception of someone like Eve, who's really running this strategy. I want to look for congruence to what they actually do. An emerging manager that invests primarily in pre-seed and seed companies that's offering me a pre-IPO deal. Maybe that's a deal that they have access to from a prior relationship, or I want to make sure I understand why that individual, why that firm is bringing that to me, and what the packaging looks like. We just had the conversation about fees. We'll talk more about it. But what are they charging? Is this going to be a distraction to what they're doing? Because I'm really thinking of this manager as someone that I'm going to give discretion to as a fund investor. But if they're bringing me a pre-IPO deal that's off-piste for them, that they can't really walk me through why it makes sense that they're bringing that to me at what point, then I scratch my head a little bit. You sort of always ask that question of, why am I seeing this? If you're not the first in line, where do you rank? How many people have said no? So there's a little bit of skepticism when there's not that congruence. But I certainly want to be able to understand the governance around it too. I mean, I think that both Sidecar and I think we'll talk about it too. You want to know what you actually own, not that you're going to have pure information rights in some of these larger later stage companies, but you do want to be able to know that you own the asset and not a synthetic version of it, which is wrapped within 3 or 4 different vehicles.
Yeah. My follow-up on that was going to be what are some of the red flags that you've seen come up around these types of deals? So you
Yeah.
mentioned one of them and like the layers and lack of transparency. Is there anything else you'd add on that or any other kind of red flags that have come up?
Yeah, I think it goes back to the idea of congruence, but are they doing this? I think of an emerging manager, right? It's hard to raise a fund in this environment. So if they're using this as a way to, keep the lights on, a way to fund sort of the fundraising process, I don't necessarily look at that as a red flag. If it feels like a cash grab, and there's a level of opportunism in this market where the number of exclusive opportunities I get that hit my inbox to invest in every company. I get 4 or 5 exclusive, unique, proprietary opportunities. So I watch for those kind of signals for folks who, again, if it doesn't make sense that they're bringing that forward, then I'm definitely that's a red flag on my book.
Yeah, I've heard from a lot of LPs in general, but especially around these types of deals, like asking themselves the question of why am I seeing this
Mm-hmm.
as kind of a framing. So yeah, definitely a lot of hype and FOMO going on. Okay, I said we'd talk more about pre pricing. So we'll start back to you, Eve, and then would love to hear from others in the group as well. But um, as we talked about it, it's definitely one of the most difficult aspects of secondary investing, and the audience seems to agree with us. So, Eve, how do you deal with, or how do you think about underwriting a deal when the last round valuations may be stale, there's limited comp data, and then can you touch on a bit like when does price cause you to walk away?
Yeah. Um, so I would argue there's not necessarily limited data, but there's limited access to data. And so a huge part of secondaries investing is figuring out how to get that access. And it can be through a number of different channels. But I think being confident to walk away if you don't have the amount of information that you need is okay. We are constantly reminding ourselves that there are 1,700 unicorns. That means there's 1,700 companies out there with valuations of over $1 billion, which just starts to get into the target size range that we think about investing. And so if we can't get the information we need to properly underwrite one of those companies, there's still 1,699 other companies that we can consider investing in. So it really is a huge pool of opportunity. But in our case, I think we think about underwriting as if these were public companies. So we are looking at historic financial performance. We're considering management projections and where management thinks these companies are going to go. We're building out our own models, kind of forecasting. Sometimes management is a little bit more bullish on the direction that these companies are going to go than what we think. And then we are looking at public market comps. And in pretty much 99% of these private companies that we're looking at, they're going to be public comps where you can understand how these companies trade publicly. Is it on a revenue basis? Is it on a gross margin basis? Is it free cash flow? But figuring out how they trade, and not just how they trade today, but how they've traded over the past 5 to 7 years, allows you to kind of incorporate that into your model, figure out what the right price point is going to be. And then if it makes sense to you, buy. If it feels high, wait. Oftentimes deals come back up. We, for example, have been monitoring Canva as a company since 2021. Loved the company, struggled with where the valuation multiple was in 2021. Now think it's a fantastic company that has really grown into the valuation multiple where you can buy it today. So just kind of putting those price points in place and having a target on a company and staying disciplined, I think is really important.
Yeah, I love the point of that the data exists. It's just about finding the right channels or versions of it. Obviously, private markets are still relatively immature as it relates to public, and with that comes the lack of like infrastructure around things like data. But yeah, kind of building your own frameworks, mental models for what makes sense to compare to, and looking at public market comps and all of that. I think it's a good point because it can be easy to be a bit lazy when in just saying like the data doesn't exist. So good counter narrative there. And maybe in the same vein of where the data is, back to you, Andrew. Obviously, Forge sees a lot of this deal flow again. So what are you seeing in terms of mispriced inventory, and do you feel like based on that, are buyers or sellers holding more leverage right now in this market?
Yeah, that's a good question. I mean, I think like an easy way to look at that is bid-ask spreads and how markets have evolved. I mean, 10 years ago, when I started in the brokerage business, everything was so secretive, especially on the institutional side. I mean, I remember brokers hiding under their desk trying to take phone calls because they didn't want the person sitting next to them to know that XYZ institution wanted to buy $10 million of DocuSign or Spotify or even Palantir. And so that's really changed. Like even 3 to 5 years ago, the market was still quite opaque and people didn't really know pricing. So what we've done with Forge Price, with our platform, what some of our counterparts have done, is really bring that pricing information out to the public. And so I think the notion of a mispriced inventory is not as relevant or common as it was 5 years ago. It's, as Eve mentioned, it's nowhere near as efficient as the public markets, just by nature of it being a private market. But it's a lot more efficient than it used to be. And I think that you see a lot of people who occasionally will run into like a large block discount or premium, just given the supply demand dynamics. But bid-ask spreads in some names are huge, and bid-ask spreads are non-existent in other names because, in a name like Anthropic, the second you see a 5-layer SPV, oh my God, it's the most amazing thing in the world. We're going to pay whatever price the seller's asking. You don't really have a ton of flexibility or leverage on what the pricing is. And so to answer the second question, buyers, I think, are disadvantaged against sellers in most names, except you have the cohort of companies that raised in 2021 or 2020 at, when interest rates were really low, at sky high valuations, that either can't raise right now or like have figured it out, and cut burn is now profitable, maybe not growing as fast as any of these AI companies. You're going to actually see a bid-ask spread there, of anywhere, and it's wide. It can be 10%, it could be 90%, depending on how well that company has done since then. But then there's no bid-ask spread in names like Anthropic, where everyone just wants to get access no matter what the price.
Yeah, and I think one of the bottom lines through all of this, or through lines I should say, is like this is all just changing really quickly. And so as we've talked about, the data is better, more available than maybe it was a year or a couple years ago. And then certainly the kind of like waves or trends in the market where there's a lot of attention and hype is going to change as some of these companies go public too. Um, Maybe I'll pull in some audience questions. We got one, and I'll leave this for any of the panelists to answer. From Naveen said, I've just started putting together an SPV for a late stage company that has completed its Series D and raised approximately $1 billion to date. I would really value your perspective on the most effective ways to source LPs within a closed network. Do you think reaching out to funds would be a good approach, or would you suggest alternative strategies?
I can start there. So reaching out to funds, I would probably only do if you have this access and they're not going to be able to circumvent you. No offense to other funds, but like there has to be some reason why they're going to look at this and say, okay, we're comfortable being in your vehicle rather than going directly on the cap table. So if there's not a lot of supply and you're really good friends with the CEO and you know that people are going to have to come through you, great. But I think that if they can, just as easily get on the cap table, going to more institutional funds might be a little challenging. And I think that more of like a high net worth family office, the types of groups that maybe aren't going to want to go directly on the cap table or aren't really sure about how that process works are probably going to be more likely to want to go into a vehicle of yours. One thing that we do when we're talking to LPs is sort of as part of our just like first call with them, we'll always ask a few questions about their interest in secondaries and SPVs. And this helps us because we're an emerging manager, we're raising our first fund, but we love using the SPVs as an opportunity for relationship building. We also don't want to hit up every single person in our CRM on every single deal that we're running into. So understanding what stage do they typically like? Do they even like to do co-investments and SPVs? What's their typical check size? Are there industries that they're really excited about or absolutely like to avoid? So that anytime an opportunity comes up, we can look at 500 names and say, well, it's really probably these 30 that are going to be most interested in this opportunity. So let's kind of reach out to them with more of a custom approach about, hey, I found this opportunity that perfectly fits what you're looking for. Do you want to learn more?
Yeah, I love that piece on understanding your LPs and their specific interests. Definitely good advice across the board, even outside of the secondaries world. But certainly when it comes to these more opportunistic deals, deals that can be often quicker moving or limited allocations, I think having that information up front can help to make the deals themselves feel a bit less transactional. Anything else from Matt, Andrew on that topic?
Hallie, I was just going to actually say very much what you just said. If I get pinged by the same person for a number of different deals a number of times, each successive deal, there's sort of a diminishing return on that. So as the LP, you want to feel like you're seeing something that others aren't, whether that's true or not. But if you're getting something from someone every week or on a very regular basis, you tend to discount those as much more of a transaction of a I'm just sending you what hit my desk today, rather than Eve's approach is the one that I would take, is curate that audience around what they're looking for rather than just, a spray and pray type of method.
Yeah, and to add to that, I mean, a significant part of our business over the last couple of years has been introducing potential LPs to emerging fund managers who either have an SPV for a specific opportunity or are looking to raise capital for, a new fund. And so I think the most important part, and Eve mentioned this at the beginning of her response, was just the differentiation. Why would someone want to invest through you versus someone else, or go directly on the cap table if that's an option? I think when a company raises a round, you're now seeing 4 or 5, 6 different funds that are, marketing access to that round with a varying fee structure. And what ends up happening is maybe it starts off at 2 and 20, and then it goes 1 and 10 because someone else is trying to be competitive. Then it's 0 and 10, and then it's 0 and 5. Then it's a 10% upfront fee. Then it's a 5% upfront fee to the GP. And so, I think that there's a transactional nature to that business, but trying to find LPs who will be with you long term is just going to pay dividends down the road.
Yeah, no doubt. Okay, we're going to get back to our questions, but we will definitely get to the other audience questions. We have time allocated at the end for that, so keep them coming in the chat. But for now, question for any of you, all of you on the panel. There's been a lot of noise around certain high-profile names that have been about to IPO for years now in some cases, and so curious how you think about exposure to those companies where the timeline is just very unclear or dynamic.
I can chime in on that. So naturally, when there's rumors about a company going public, I think you see a ton of inbound interest from buyers and oftentimes sellers who are trying to think about getting liquidity near term versus long term. And even if a company is expected to go public this year, there's going to be some sort of lockup 6 months post IPO. So now you're looking a year and a half away from liquidity. So that kind of factors into how much or if you want to sell. But I also think it's become less important over the years with the SPVification of everything. Liquidity on the back end is significantly easier because you don't necessarily have to go through company approval to get that liquidity. And so that plus very few companies are going public, and over the last couple of years, there have only been a handful. So I think people are buying and then selling and then buying and then selling in the secondary market before the company ever goes public. And so it's not necessarily, oh, I'm just trying to get into these companies before they go public. I'm just trying to get into these companies so that I can actually, make money off of this and extract value from the appreciation before it goes public. If that makes sense.
Matt or Eve, anything you'd add there?
Yeah, I think one thing that we do with everything we invest in is we have price targets for what we think the exit should look like. And every quarter, as we kind of get additional information or different insights into the companies that we're invested in and that we have on our watch list, we update our price targets for where we want to buy. But we also update our price targets for where we would sell. And so maintaining that kind of mindset rather than just waiting for, there are lots of companies out there where I think people have been waiting 4 years for that about to IPO to happen. And so you can totally hold through an IPO. That is completely fine. But knowing that if you're operating in the secondary markets, like we've made investments where I could call Andrew tomorrow and say, hey, Andrew, we'd love to sell this at this price point or higher. Do you think there's a market for that? I think Andrew would either tell me I'm out of my mind or yes, we have demand. But being willing to generate exits for yourself, not just relying on an IPO, can be pretty important.
Yeah, I love the point about having the price that you'd sell it to, because I think, when you see a company in your portfolio accruing value, maybe very quickly, it can be easy to change your initial perspective, get overly excited and feel like, no, let me just hold out another 6 months, 12 months. And it becomes more of an emotionally charged decision. Whereas if you've kind of prepared your mind for like nope, this is our threshold, then it makes it much easier, hopefully.
Well, how I think that is so true. I think most LPs, though, this about to IPO phrase, we've been thinking about it for the last 3, 4, 5 years. I think of Canva and Databricks, and Stripe, and like think of all these companies that we were looking for that liquidity from. And now you're adding on top of that those next five names where we can see maybe a light at the end of the tunnel where there is going to be some liquidity from a public exit. I think that's where LPs are just maybe a little gun shy. So they say, okay, what companies are about to IPO? When can we expect that? This is really putting pressure the last 5 years really around DPI, around investors looking to get capital back into their portfolio so they could recycle it into new names. So that's part of I love this idea of being able to buy and sell pre-IPO, right? In when that window is getting closer and closer, the same way you think about an option expiration, there can be a lot that happens right before that execution date. But in reality, I think LPs have gone through this high and low of getting ready to get some liquidity and have it fall away. That they're to just a little bit uneasy about what the market's telling.
Yeah, Matt, we're going to continue on with you in a
Yeah.
similar vein. How's LP appetite for pre-IPO exposure holding up right now? And speaking again to like the extended IPO drought, if we're calling it that still,
Mhm.
have the dynamics around that changed? And how are you advising GPs who want to incorporate more late stage secondaries into their strategy?
Yeah. So I think the first piece in terms of appetite holding up, it's a little bit of a twofold answer. I think a lot of LPs have pre-IPO exposure in their books that has been building up over time. So in some cases, they don't necessarily have net new appetite for that because when they look at their portfolio, it does skew later stage, bigger dollars, higher percentage of value. Anecdotally, there were two endowments that said they had high single digits exposure to SpaceX, right? To one company within the whole endowment. I mean, that's a little bit mind blowing. Where to what we just talked about, is there a way to take some of those chips off the table? Uh, yes and no. So I think you have that dynamic where some folks already look at their portfolio now. They say, we have plenty of this. We don't necessarily need to add anything. That clock is getting closer. We can get some of this liquidity now. On the other side, I think as LPs think about just an overall, think of it almost as a laddered approach. When I invest in a pre-seed or seed fund, I understand that it's going to be 7 to 10 years till I get liquidity on most of those positions. That's extended almost, 3 to 5 years. So it's 12 plus years before a lot of those companies go out or generate liquidity in a meaningful way. So I think people are thinking about how do you supplement that? And yes, it's through individual names. I still think that presents a lot of idiosyncratic risk from an LP's mind. Yes, they would be happy to own smaller pieces of these companies, but are they big enough to make an impact on the overall DPI on the distribution profile of their venture portfolio, which is likely a smaller piece of their overall portfolio? So you wonder about the tactical versus the tactical within the venture portfolio versus in the overall. So I do think you have some folks who are looking to gain exposure to some names to kind of build out a little bit more of that even out the distribution profile. I actually think, and hopefully this is the case for you, Eve, where I think folks are looking at individual names as a little bit harder to come by. To the point before, right? A position in Anthropic is going to trade in maybe less than a day. So it's very hard for an institutional LP to be able to make that move in and out. So a pool of assets or a manager who can actually execute that strategy, I think makes a lot more sense for those groups. So I think we're still in the early innings of that. So which groups will be the most likely to, invest in those types of strategies? Likely the groups that have more immature venture portfolios. So they've been building and building over time. They haven't seen any of that liquidity yet. So maybe they can invest in some of these companies that are a little bit closer.
Yeah, seems like another good reminder, proof point to know your LPs, understand what their
Mhm.
portfolio is, what their venture portfolio is, what their portfolio is outside of venture, so that you can again, like cater your asks appropriately to
Mhm.
those dynamics. Um, cool. Thank you guys for the questions in the chat. Like I said, I promise we'll get to them because there's some juicy ones, but we'll do one last question from our list for all of the panelists. Kind of just a general one for an emerging manager sitting in the audience today who wants to do, let's say, their first pre-IPO or secondary deal. What's one thing that they need to get right to execute well?
Yeah, I can start off. So I think there's two things that I would focus on. One, you obviously need to diligence the issuer that you're investing in, and you also need to diligence the opportunity that you're doing it through. If you're not direct on the cap table, it's really important to understand who you're working with and what the landscape looks like. Are you working with a broker? Is that broker credible? There are a lot of not so credible brokers in this business, unfortunately. And you got to make sure that they're showing you what you actually want to invest in or what they say the opportunity is. Are you talking directly to the seller? Why is the seller selling? It doesn't necessarily always concern you, whether it's personal liquidity needs, they want to buy a house. I mean, I've seen a lot of different stories over the years. But that's also important in kind of factoring why this person is selling and why you want to buy. And then if you're investing through an SPV, just understanding the congruency that Matt talked about earlier. Is this something that they do normally? Is this a side job? Do they have any skin in the game? I think that it's really important to make sure that everyone's incentivized appropriately, both as an investor and a fund manager.
I might just piggyback on that, Andrew, where if I get approached and somebody can't tell me the structure all the way down to the position level, I'm going to be very hesitant to do that. So kind of nailing that, so I, as the investor, can feel comfortable with the counterparty risk I'm taking there. Just that's not something I'm going to be able to diligence on my own in a lot of ways. So the more you can present that up front, the more edge you'll have.
Absolutely.
Yeah, and I don't know if this is that different from what the other two have said, but for us, it's really about conviction. And I think it's conviction operationally that you trust the people who you're working with, that you are going to have, if it really matters to you to get distributions in kind rather than cash. Are you going into a vehicle where that's going to be allowed? Are you going to be able to sell out of it if this company stays private for 5 more years? Do you want to try to negotiate some kind of information rights in a side letter? There's a lot of just different things operationally where you want to make sure those boxes are being checked for you, where you should potentially be waiting for another deal. And I think the other conviction you need to have is just in this company. I mentioned this earlier, but you're putting your name and your stamp of approval onto any vehicle that you're building out. And so looking at these companies and saying, am I going to be excited to have this on my track record? And 2 years from now, if things don't pan out as perfectly as I think they're going to, and am I going to be able to defend why I still did this deal and why I thought it was a good opportunity at the time? But I think having conviction operationally and in the company is really important.
Yeah, I appreciate you saying that because conviction is obviously a term that is thrown around a lot in our industry. And I think a lot of what you just said, as well as previous comments around just like having that prepared framework and mindset for buying and selling, really speaks to like what it actually takes to get to the point where you can see a deal and maybe know if you have conviction more quickly. But there's all of this background work that goes into getting there. Okay, cool. We'll get to some audience questions. And we've got a couple in the queue, but feel free to continue sending them over. First one from Ari. How do you look at deals that come through finder type intermediaries as opposed to funds or promoters? The access is often based on network effects or fortuitous interactions as opposed to marketing and cold outreaches. These are often truly proprietary with no formal process.
I mean, I can start, although I am an intermediary. So I don't know, Matt or Eve, do you want to? I think you'll probably have slightly different perspectives. So maybe better if you two go first.
Um, from my point of view, it's like the weirder the better. And kind of just like finding these channels where we had a deal where my co-founder ran into someone at the gym who we knew from college. And it turns out that guy was an early employee of a really cool company, wanted to buy a house, which is what I feel like why most people sell. But yeah, he just like was at the gym at the right place at the right time. And those kind of channel opportunities are really exciting because that is where you can be a bit more kind of proprietary, and explain to LPs, when I reach out to Matt and say, I have the deal of a lifetime, Matt's not saying, am I call number 72? Matt saying, wow, I love this company. This is exciting. I don't know how you got this access, but that's great. So I like strongly encourage thinking outside of the box. We met someone recently who was a broker, like real estate broker for OpenAI employees, and we were buying something from her on Facebook Marketplace. So like lean and yeah, she got excited, made some connections, but lean into like talking about your job and your excitement for secondaries everywhere. Be ready to explain to people what secondaries are, and opportunities will just come from like very weird places.
If you go to like
But
a
I'm
Starbucks,
hearing,
if you go to a Starbucks and say, I have Anthropic shares, you're gonna get swarmed. Yeah.
I was
Yeah,
going to say, I'm hearing that we should all go to the gym more.
yeah, everywhere.
Hard pass.
Anyone else on that last one, or are we good for the next question? We got plenty more. Eve mentioned it is a mixed bag on the secondaries deals after the top 15 deals or companies. What are the sectors and areas that are attractive? Defense, fintech, health tech, space, etc. I can queue this one up because we do have data on this, but would love to hear what others are seeing. So, yeah, it's defense, space, and AI. I'm not going to get the numbers exactly right, but I think around 37% of secondaries on our platform in any given month or quarter are in those kind of 2 to 3 buckets. And we have a report on this, so maybe we can drop that in the chat or follow up with it. But those are definitely what we're seeing. Anyone else?
I mean, for me, if I think of the inbound that I get, it tends to fall in those same baskets. Similar to what Eve said, just on the last question, if I see something that's a little bit different, it may catch my attention a little bit more, right? So maybe it's in another sector, and there are plenty of great companies in each of those segments. They just don't have as much, regular flow. So I think sometimes that has the appeal of, oh wow, this is not something I'm seeing every day. So while it's counter to what the question was asking, where's the vast majority of the deal flow, when there is a top bio company or health tech company or consumer company that comes through, may be very interested in digging in a little bit more versus the 10th person that's send a message about the next defense company.
Yeah, I think on our end, and Andrew, you probably have a lot more data on this, but just anecdotally, I am always prepared to talk about the impact of AI. Doesn't matter what the sector is. First 3 questions I'm going to get from every single LP I talk to about any single deal are going to be, how does AI impact this? How does AI tie in here? How are the public market comps faring in the face of AI? So I think it like this sector, yeah, defense, we see a fair amount of kind of interest there. But like everything has this AI tie-in. And so being prepared to explain very explicitly how the next Claude rollout is not going to decimate whatever business this is really important.
Yeah, I mean, I think to pull some more data, I want to say in between 80 and 90% of our volume is in top 10 companies. And those are mostly in the space, in the defense, and in the AI sectors. And so there's a huge convergence. But I also, as Matt mentioned, there's other names. Fintech is kind of making a comeback in a few subsectors of fintech, healthcare tech as well. You have industry leaders in each of these, maybe not tier 2, but not the main 3 sectors that we just talked about, that are doing really, really well. And oftentimes they have an AI component that is enabling that growth. So there definitely are opportunities outside of the 3 main sectors that I think are worth looking for too.
Yep. Everything is AI, if you really think about it. I like this next question. It's around oops, sorry, I lost it. How do you think about SPV fee structures? Seems like the market is getting gradually more phobic of carry and less concerned about massive upfronts.
I can tackle that one since I spend all day looking at them. So I think there's a couple different pieces to this question. The difference between carry and an upfront fee for LPs or investors is really a math problem. How are you valuing the future value of this asset, and at what point does it make sense to have a carry, to tolerate paying a carry versus an upfront fee? Then there's a differentiation piece. What else is available in the market? And so I think that if 6 different SPVs come to market at the same time because they're all, giving access to the same asset, as I mentioned earlier, you're going to see an absolute race to the bottom in terms of who's going to be the most competitive as they're vying for assets, so that they don't tell the issuer, hey, I said I could do 30, but I can really only do 8 million. Please don't cut me out. And so I think on one end, you have the investor's desire, and the fund manager's desire is naturally going to be carry. And I think that one thing that investors need to also just keep in the back of their mind is that when a fund manager doesn't have carry, their incentive is not aligned necessarily with the investor. If there's no carry and they just take an upfront fee, they don't care if the company goes bankrupt. Technically, they've already made their money. And so a good steward of your investment is kind of, there's a big question mark on that. And so you want your K1 on time? Well, I've already made my money. I don't really care about that anymore. Obviously, that's a generalization, but I think that you have to keep in mind the whole picture of life's about incentivization. So what does that tell me about this opportunity?
I was going to say the same thing, Andrew. That's exactly what I would look for. And a huge upfront fee means I'm on to the next thing. A carry means this does matter to me going forward. And I think those are the distinctions between the two. I would also posit that most LPs aren't actually doing the underwrite on the outcomes here, right? In a lot of cases, they just want to own the logo, especially for these top handful of assets. So they may not even have the pencil to paper on the impact of the difference between the upfront versus the carry. That may be, I may offend some LPs by saying that, but I think in a lot of these cases, there's not an off the shelf pricing like you would think about it in a fund secondary, or even something where you may have a little more time to pencil it out. So it may just feel like what's the path of least resistance? How can I get something done?
Yeah. And one other note, and this might be very obvious, but this was a lesson we had to learn, is expenses are another part of this. And if this is a vehicle that's going to exist for 3 years or 4 years, and you're going to be getting it audited and you're doing annual taxes on it, those expenses add up, particularly on a small vehicle, because a lot of those expenses are fixed, whether this is a $1 million SPV or a $50 million SPV. And so I think the expenses part oftentimes gets overlooked, but making sure that with these vehicles, in addition to any kind of management fee and carry and whatever you're negotiating there, try to make sure that expenses are also passed on, or that you have a very good plan for what you're going to do if you're left holding this asset in a vehicle for 10 more years. Because that can happen. And if you've only charged a, 3% upfront fee, and yeah, maybe there's carry at the end of it, but you're kind of stuck in this opportunity for 10 years, your entire management fee could end up going towards expenses.
Really good point. And yeah, make sure to tell the story to your LPs around that if you're taking a higher management fee, because you know that there is some operational expense associated with the vehicle, like that I would imagine is going to be received very differently than just a big upfront fee, no carry. Again, seems like they're kind of checked out.
Hallie, I have a question for Matt and Eve.
Yeah.
What's the craziest fee structure you've ever seen on an SPV?
I mean, the craziest I would tie to richest, where I saw one recently where it was 10% upfront. It was a 1.25% ticking fee, a management fee, and then it was a 20% on the back. So I don't actually know if it's crazy relative to the things that I'm seeing that are much more in a different bound that fell way outside of.
What about you, Eve?
I mean, I for the most part see my deals, where fees are very reasonable and brilliantly set, and there's a lot of thought that goes into them. No, but I think you get into some of these double layer where there's a one-time fee, there's a recurring management fee, there's carry, and then also the price that you're paying is 50% higher than the most recent round, which closed a quarter ago. And I'm like, wait, so I'm just trying to figure out where all the money is going and where all the layers of fees are coming from, and untangling that can cause a bit of a headache. But I don't think I've seen anything crazy creative structures. I don't know. Andrew, what have you seen?
Yeah, I think we have to ask Andrew now.
Yeah, I just have like the scene from Wolf of Wall Street of Matthew McConaughey pounding his chest. Um, we saw something last year that was double layer. It was 25% upfront fee to the second layer, and then there was a 20% carry on the first layer.
And those are the kinds of deals where if you go into something like that, you're not going to be able to sell your position. Um, and so like the fee structure should be something that you think about as an LP going into one of these vehicles or as a GP if you're going into someone else's vehicle. Like if you need to exit, like when things get bad, if you're in a really good asset, you can probably still get your money out. When things get bad and you're in a good asset, but you have paid a 25% upfront fee, which like really raises your cost basis, and there's 20% carry on it, no one's going to buy that from you. And so like wonky structure should kill deals. And like find something better.
Yeah, I mean, we say no to the majority of opportunities that external brokers bring us because there's either five people in between the deal and the broker bringing it to us, or there's just, as Matt said earlier, if you can't answer every question about the structure, like every layer of the onion that you peel back, if it's still raising more questions, you have to keep peeling layers, then you're just like, this is going to be a disaster. And then, when markets are frothy like they are now, there's a lot of people that come out of the woodworks that have never done this business before, who aren't even licensed, and are just like, oh, I know someone. I have a $400 million buyer of Vanderbilt. Like, do you have anything? Like, if we did, we probably wouldn't show it to you. Like,
Um, well, we're quickly coming up on our time, but you kind of set me up perfectly for the last spicy question, which I'll grab from the audience. And again, we have 2 minutes to answer this one, so take that with a grain of salt. But it seems like there's an increasing dislike for SPVs from some of the top tier private companies. Do we think this is a trend that will continue, or do we think this is just a moment in time?
I can go really quickly. I think incentives need to align from the company, the issuer perspective, and the investor perspective. If the investor is just taking something off the top and not a long-term investor who's going to be providing value in return to the company, then that's, I think you're going to see an increasingly large amount of hesitancy from issuers on SPVs.
Yeah, my answer was going to be around that. Back to the word congruence, but just the alignment between the two, right? This doesn't work if only one party does something.
Yeah. Companies need to start going public. And if they're not, you are always going to have people who have a need for liquidity, whether it's a seed stage investor and it's been 15 years, or an early employee who left 5 years ago. People need to find avenues for liquidity. And so I think if companies don't like the, SPVs on SPVs and want to like really maintain more control of their cap tables, it's a great reason to go public.
Amen. Well, we're perfectly at time. So thank you, panelists, so much. This is a fantastic conversation. Thanks to the audience for coming along with us and asking good questions. And hopefully you learned something. And that's all we got for today. Bye, guys.
Thank you.
Bye,
Thank
thanks.
you very much.